Hey folks, have you noticed something deeply wrong with your favorite Target stores lately? Once the shining star of retail, Target is now spiraling into chaos. In this video, we're breaking down 20 signs Target is in deep, deep trouble. From staggering sales drops and inventory nightmares to a crumbling brand reputation and leadership failures, Target's decline is nothing short of alarming. Target's situation is a perfect storm of poor strategic decisions and failure to adapt to the evolving market. They're losing ground on every front, and if they don't act fast, the fallout could reshape the entire retail landscape. Stay with us as we uncover the harsh realities behind Target's downfall and what it means for shoppers and the future of American retail. 20 signs Target is in deep, deep trouble. Let's dive in. 20. Target's sales have been declining at a breathtaking pace, with internal figures obtained by retail analysts showing that year-over-year comparable store sales plunged by a staggering 14% in the most recent quarter, a rate not seen since the Great Recession. Shoppers, previously lured in by the retailer's Target allure, are simply not feeling compelled to spend money on the retailer's shelves stocked with stale merchandise and a never-ending rotation of inventory clearance events. The slip in foot traffic has been confirmed by location tracking data provided by Placer.ai, which indicates a consistent drop in customer visits for 8 consecutive months. This massive slump in demand has led to poorly performing stores quietly slashing operating hours, cutting in-store staff, and, in some desperate cases, shuttering entire departments to reduce costs. The gloom deepens further as Target struggles to push back against Walmart's aggressive price-matching strategies and Amazon's unmatched online convenience, leading to a brutal market share erosion that grows more severe with each passing season. If these trends continue, insiders warn that Target's once iconic bullseye may become the poster child for the retail carnage gripping the nation's once thriving consumer sector. 19. On top of the disastrous sales meltdown, Target is facing an unprecedented inventory glut that has been strangling its profit margins since last summer. Financial reports and supplier statements confirm the company misjudged consumer demand, resulting in truckloads of unwanted goods piling up in back rooms and distribution centers. Clothing lines that failed to attract younger shoppers, bloated home decor assortments that never caught on, and gadgets nobody needed are now being offloaded at bargain basement prices in a desperate attempt to salvage some liquidity. Retail experts note that this type of inventory mismanagement can be lethal in today's volatile environment, where the ability to quickly adapt and pivot merchandise strategies often marks the difference between staying alive and going under. All of this has forced Target to throw itself into a cycle of endless markdowns, hammering its balance sheet and stoking fears among investors who are now becoming increasingly anxious about the company's long-term viability. Without a dramatic revamp of its product assortment and sharper forecasting methods, Target's bloated stockrooms may become the visible symbol of a once-beloved brand losing its way. 18. Another glaring sign of Target's deep troubles lies in the collapse of its once-vaunted supply chain, which is now creaking and groaning under the strain of global disruptions, rising freight costs, and a labor market in turmoil. Supplier delays, shipping bottlenecks, and logistical nightmares have plagued the company for months, with key seasonal merchandise arriving too late, or never arriving at all, causing entire marketing campaigns to falter and customers to leave disappointed. Internal memos leaked to industry insiders point to severe operational inefficiencies, outdated warehouse technologies, and costly reliance on third-party logistics partners that are charging premium rates to keep merchandise flowing. These mounting supply chain struggles translate directly into empty shelves at critical sales periods, denting the trust of loyal consumers who used to count on Target's reliability. Competitors that have invested heavily in cutting-edge distribution methods and strategic supplier alliances are quickly pulling ahead, while Target's management scrambles to patch glaring logistical holes that threaten the retailer's very ability to function at scale. 17. Target's brand identity, once the envy of the retail world, is also unraveling at the seams. Gone is the mystique of a curated upscale shopping experience at affordable prices. In recent consumer surveys gathered by the research firm Keyset Analytics, shoppers describe Target's current store environment as chaotic, disjointed, and painfully bland. The cohesive look that once drew in suburban moms and trend-seeking millennials is fading, replaced by confusing product layouts, inconsistent marketing messages, and poorly executed partnerships with struggling apparel and decor brands. Even the much-touted in-house private labels fail to stand out in a sea of clones, leaving customers questioning what Target truly stands for in an era of hyper-competitive retail. This brand erosion is further compounded by a barrage of negative headlines, ranging from privacy concerns in the wake of data breaches to accusations of poor labor practices that have chipped away at the company's once flawless reputation. Without a clear vision to differentiate itself in the retail marketplace, Target risks fading into irrelevance as consumers latch onto brands that offer a stronger sense of identity and purpose. 16. Compounding these challenges, Target's digital transformation efforts are sputtering just when seamless online to offline experiences matter most. For years, Target tried to position itself as a tech-savvy competitor to Amazon, pouring billions into website overhauls, data analytics, and same-day delivery services. But according to IT insiders and digital marketing specialists familiar with the matter, those investments haven't paid off as expected. Glitches and downtime on Target's website are becoming alarmingly frequent, while slow load times and poor personalization features are driving frustrated shoppers straight into the arms of more agile rivals. Even the retailer's attempts to integrate its pickup and drive-up services have fallen short of consumer expectations, with order mix-ups, long wait times, and inadequate staffing hindering what should be a friction-free experience. As e-commerce continues to set the tone for the industry's future, Target's patchy digital performance presents a serious red flag that it's slipping further behind in a battle it cannot afford to lose. 15. There is the ominous cloud of mounting financial strain that could soon hit Target like a wrecking ball. Recent earnings calls have been marred by ominous tones from top executives who hint at the need for drastic cost-cutting measures, including a renewed wave of store closures that will leave certain communities without a familiar shopping destination. Analysts at Wall Street institutions have lowered their price targets for Target's shares, citing weaker-than-expected earnings, massive debt obligations, and an alarming cash burn rate that cannot be sustained indefinitely. The tightening credit environment and the prospect of further interest rate hikes will only intensify the financial pain, raising the stakes for a retailer that must now fight tooth and nail to remain competitive. If Target fails to address its systemic problems and regain investor confidence, its golden era could be remembered as a distant memory, and the bullseye may soon symbolize nothing more than a once-great brand struggling to stay relevant in a fast-changing world. 14. As if eroding brand loyalty and profit margins weren't enough, Target is also dealing with an internal crisis that's gnawing away at its foundation: collapsing employee morale. Multiple reports from labor groups and insider testimonies indicate that workforce dissatisfaction is spreading like wildfire through the company's ranks. Stressed-out store associates are being stretched thinner than ever, frequently assigned impossible workloads due to staff reductions and efficiency mandates that seem more like desperation moves than strategic decisions. On Glassdoor, and indeed, a flurry of negative reviews from disgruntled employees highlights worsening working conditions, unresponsive management, and wage packages that simply don't keep up with the burdens placed upon them. High turnover rates are pushing training costs up and productivity down, and the deterioration in customer service is already noticeable, with shoppers complaining about indifferent or non-existent floor assistants. If Target's team members, once counted on as the friendly face of the chain, are losing faith in the company's future, it's only a matter of time before the entire enterprise suffers irreparable reputational harm. 13. Beyond the mounting internal struggles and battered bottom line, Target is being besieged by a crushing wave of competitive pressure that intensifies with each passing quarter. Established giants like Walmart and Costco are muscling in harder than ever, flaunting leaner cost structures, sharper pricing strategies, and renewed commitments to customer experience. Meanwhile, dollar stores and niche specialty retailers are snapping away at Target's market share from all sides, peeling off consumer segments with laser-focused merchandising and ultra-convenient store footprints. Even online pure plays and fast fashion juggernauts are deftly encroaching on Target's turf, capitalizing on cultural shifts and tech-savvy shoppers who expect instant gratification, personalized recommendations, and lightning-fast delivery. The market is becoming a battle royale from which only the most adaptable, resource-rich, and innovative players will emerge. Right now, Target looks more like a wounded competitor caught in the crosshairs, vulnerable on multiple fronts and losing ground in skirmish after skirmish. 12. As the retail arena becomes more unforgiving, the retailer's profit margins are getting shredded by a combination of inflationary pressures, relentless discounting, and a stubbornly high cost structure. From escalating wage demands to skyrocketing energy bills and bloated leases, every line on Target's expense sheet is ballooning just when revenues are faltering. To keep customers walking through the doors, Target is slashing prices on previously premium goods, an act of financial self-harm that leaves its net income bruised and bloodied. Suppliers, too, are pushing higher input costs onto the retailer, further squeezing the margins and forcing a vicious cycle of last-minute promotions and clearance events that do little but cannibalize potential profits. In short, the company is pinned between the rock of operational overhead and the hard place of consumer price sensitivity, making it nearly impossible to carve out the robust earnings it once enjoyed. 11. Target's over-reliance on the holiday season and a few key promotional windows to turn a profit is another glaring sign of deep instability. Retail insiders note that the company's sales and traffic patterns have grown disturbingly dependent on the fourth quarter's gift-giving frenzy to mask underlying weaknesses. When holiday volumes fail to meet internal forecasts, which they have recently, the entire annual budget gets thrown into chaos, forcing frantic budget cuts, halts in planned expansions, and emergency cost reductions that ripple throughout the company for months on end. This precarious business model is akin to building a house of cards atop a windy bluff. One bad shopping season or a slight miscalculation in consumer sentiment, and the entire structure could collapse under the weight of its own seasonal vulnerability. If Target cannot find a more balanced and sustainable revenue mix across different times of the year, it risks being knocked flat by forces as simple as a lukewarm holiday rush or a last-minute shift in buyer preferences. 10. Long-touted partnerships and celebrity collaborations once helped Target differentiate itself, offering exclusive product lines and a sense of specialness that customers were willing to pay for. But lately, these alliances have turned into little more than window dressing on a deteriorating storefront. Several high-profile tie-ups with designers and influencers have fizzled, failing to generate the once impressive spikes in traffic and publicity that were central to Target's marketing magic. Leaked documents and insider chatter paint a picture of disjointed negotiations, partners disappointed by lukewarm sales, and a branding strategy that's increasingly out of sync with the cultural zeitgeist. Instead of breathing new life into the retailer's product mix, these collaborations frequently result in cluttered clearance racks and bitter brand ambassadors, effectively eroding the Target mystique. Without transformative partnerships that truly resonate with shoppers, the retailer's attempts to stand out will remain hollow, and its product offerings risk turning into a dull echo of more nimble rivals. 9. At a time when capturing growth categories like wellness, sustainable living, and experiential retail could create new revenue streams and draw in younger demographics, Target's attempts to break into these booming markets appear half-hearted and underdeveloped. Where competitors are investing in dynamic in-store experiences, top-tier organic groceries, or innovative rental and resale models, Target remains anchored in an older paradigm. Research from retail consulting firms shows that the younger shoppers Target desperately needs, digital natives who value transparency, ethical sourcing, and cutting-edge convenience, see the brand as lagging behind, providing an environment that feels stuck in the past. Missing out on these crucial growth opportunities isn't just an oversight, it's a strategic failure that could seal the company's fate. As emerging market segments solidify their hold on the modern consumer's wallet, Target's reluctance or inability to evolve will only accelerate its decline, making it harder and harder to regain the forward momentum that once propelled it to the top tiers of American retail. 8. Target's efforts to cultivate customer loyalty through its Red Card program and other engagement initiatives have lost their luster. Initially, these programs offered attractive discounts and perks that incentivized repeat business. However, recent evaluations by marketing analysts reveal that the benefits have become less compelling compared to competitors' offerings. The Red Card now provides minimal savings, and the exclusive deals that once set Target apart are either infrequent or poorly advertised. Additionally, the lack of personalized experiences and rewards tailored to individual shopping habits has made the loyalty programs feel generic and uninspiring. Customer feedback indicates a growing dissatisfaction with the perceived value of these programs, leading to a decline in enrollment rates and reduced repeat visitation. Without revitalizing its customer engagement strategies and enhancing the appeal of its loyalty programs, Target risks alienating its base and ceding further ground to retailers who excel in creating meaningful, personalized shopping experiences. 7. Target's foray into international markets has been nothing short of a strategic fiasco. The retailer's attempts to replicate its U.S. success overseas have been marred by cultural misalignments, logistical challenges, and stiff local competition. Stores in Canada, for instance, struggled with supply chain inefficiencies and a lack of product localization, leading to a rapid withdrawal that not only resulted in significant financial losses, but also tarnished the brand's international reputation. Similarly, ventures into other regions have been hampered by inadequate market research and an underestimation of local consumer preferences. This pattern of missteps has drained resources and diverted attention from stabilizing and improving domestic operations. As global retail landscapes become increasingly competitive and diverse, Target's inability to effectively navigate international markets underscores a critical gap in its strategic planning and execution, limiting its growth potential and exposing it to heightened risks in its home market. 6. While the retail industry pivots heavily towards e-commerce, the physical store remains a crucial touchpoint for brand experience and customer engagement. Target, however, has fallen behind in optimizing its brick-and-mortar locations to meet contemporary consumer expectations. Store layouts are often cluttered and inefficient, making navigation cumbersome and detracting from the overall shopping experience. Investments in store modernization have been sporadic and insufficient, resulting in outdated fixtures, poor lighting, and a lack of interactive elements that could enhance customer engagement. Furthermore, the integration of technology within stores, such as self-checkout systems, digital kiosks, and augmented reality features, has been sluggish, failing to provide the seamless and innovative experiences that today's shoppers demand. As a result, customers perceive Target stores as less inviting and less convenient compared to the sleek, technologically advanced environments offered by competitors. This neglect not only diminishes foot traffic but also weakens the emotional connection between the brand and its customers, making it harder to foster loyalty and drive sales through physical channels. 5. In an era where sustainability is a key driver of consumer choice, Target's environmental initiatives appear lackluster and insufficient. Despite some efforts to introduce eco-friendly product lines and reduce waste, the company has been criticized for not doing enough to address its overall environmental impact. Reports from environmental watchdogs highlight Target's slow progress in reducing carbon emissions, minimizing plastic use, and implementing sustainable sourcing practices across its supply chain. Additionally, the company's sustainability marketing often falls short of transparency, leaving consumers skeptical about the genuine commitment behind its green claims. This skepticism is compounded by instances where Target has been linked to environmentally harmful practices, such as excessive packaging or inadequate recycling programs in stores. As eco-conscious consumers increasingly prioritize sustainability in their purchasing decisions, Target's perceived inaction in this domain risks alienating a significant and growing segment of the market. To regain trust and align with modern values, Target must accelerate its sustainability efforts, invest in genuine environmental initiatives, and communicate its progress transparently to consumers. 4. At the helm of Target's current struggles is a leadership team that appears out of sync with the rapidly evolving retail landscape. Recent turnovers in key executive positions have led to inconsistent strategic directives and a lack of cohesive vision. Industry insiders reveal that internal conflicts and a failure to prioritize critical areas such as digital innovation, supply chain resilience, and customer experience have hampered the company's ability to respond effectively to emerging challenges. The absence of a clear, forward-thinking strategy has resulted in reactive rather than proactive decision-making, leaving Target vulnerable to market shifts and competitive pressures. Moreover, the leadership's reluctance to embrace bold, transformative changes has stifled innovation and hindered the company's ability to capitalize on new opportunities. Investor confidence has waned as stakeholders express concern over the uncertainty surrounding the company's direction and the perceived lack of strong, visionary leadership. Without a decisive and inspired leadership team to steer the company towards a revitalized and sustainable future, Target's prospects remain bleak, and the path to recovery remains unclear. 3. Target's reputation among consumers has taken a significant hit, with customer satisfaction scores plummeting across multiple metrics. Recent surveys conducted by consumer research firms reveal a stark decline in Net Promoter Scores, NPS, indicating that fewer customers are willing to recommend Target to others. Common complaints center around poor in-store experiences, such as disorganized layouts, unresponsive staff, and long checkout lines. Online shoppers are equally frustrated, citing issues like frequent website outages, inaccurate product listings, and delayed order fulfillment. Social media sentiment analysis shows a rising tide of negative mentions, with customers sharing their dissatisfaction and switching their loyalty to competitors like Walmart and Amazon. Additionally, negative reviews on platforms such as Yelp, Google Reviews, and Trustpilot have surged, further tarnishing Target's image. High-profile incidents, including data breaches and controversies over product quality, have garnered extensive media coverage, amplifying the negative perception and eroding trust among both existing and potential customers. This erosion of brand reputation is not only diminishing current sales, but also making it increasingly difficult to attract new shoppers in an already saturated retail market. 2. In the rapidly evolving retail landscape, innovation and adaptability are crucial for maintaining competitiveness. Target has struggled to keep pace with emerging market trends and consumer preferences, resulting in a stagnant product offering and outdated business practices. While competitors are swiftly adopting technologies like artificial intelligence for personalized shopping experiences, augmented reality for virtual try-ons, and advanced data analytics for inventory management, Target's initiatives in these areas have been sporadic and ineffective. The company's product lines lack the innovation seen in rivals, with few new exclusive brands or cutting-edge products to entice modern shoppers. Additionally, Target has been slow to embrace sustainable and ethical sourcing practices that are increasingly important to today's consumers, further alienating a significant market segment. The lack of agility in responding to shifts, such as the rise of experiential retail, the demand for omnichannel integration, and the preference for subscription-based models, has left Target lagging behind. This failure to innovate not only diminishes Target's appeal to tech-savvy and trend-conscious customers, but also limits its ability to differentiate itself in a crowded marketplace. 1. Imminent bankruptcy and potential collapse of operations. The cumulative impact of Target's multifaceted struggles has culminated in a dire financial predicament that threatens the very existence of the company. As of 2024, Target's balance sheet reflects alarming indicators of distress. The retailer is grappling with unsustainable debt levels, exacerbated by plummeting revenues and soaring operational costs. Credit rating agencies have downgraded Target's debt, making borrowing more expensive and limiting access to essential capital for operations and strategic initiatives. Cash flow statements reveal a persistent negative trend, with cash reserves dwindling rapidly due to continuous losses from declining sales, excessive markdowns, and escalating expenses related to store closures and digital infrastructure investments. Investor confidence has plummeted, leading to a sharp decline in stock prices and increased scrutiny from shareholders demanding immediate corrective actions. Additionally, mounting lawsuits and regulatory fines related to supply chain disruptions, data breaches, and labor disputes are further straining financial resources. The combination of these factors has placed Target on the brink of insolvency, with bankruptcy filings becoming a tangible threat if turnaround efforts do not materialize swiftly. Without decisive and effective intervention, Target is poised to face bankruptcy proceedings in 2025. The company's inability to stabilize its revenue streams and control costs will likely lead to an inability to meet debt obligations, triggering default scenarios that could initiate Chapter 11 bankruptcy filings. Such a collapse would not only result in the liquidation of assets, but also the closure of a significant portion of its store network, leading to massive job losses and further eroding consumer trust. In the event of bankruptcy, Target could be forced to sell off key assets, including real estate and proprietary brands, to satisfy creditors, effectively dismantling the once iconic retail giant. Moreover, the loss of market presence would create a vacuum in the retail sector, allowing competitors to capture Target's remaining market share and customer base. The brand's dissolution would serve as a stark warning to other retailers about the consequences of failing to adapt to a rapidly changing market landscape. In the worst-case scenario, Target's collapse could trigger a ripple effect across the retail industry, highlighting the critical importance of strategic agility, financial prudence, and customer-centric innovation in maintaining long-term viability.